We have a large roundtable here for the LSCRE podcast. We've got the founder, Rob Beardsley, and the sheriff, the partner, Sam Morris, here today to talk about a great agenda. I am Craig McGrother, and we are on the heels. Actually, no. Today's a summit event, technically, because we are a little bit pre-recorded here and early. Today's a summit event. Everyone's having a great time. It was the best one. This is probably the last one, but seriously this time. Or it's not. I don't know. Who knows? No one knows. But with that said, we got a great agenda today. And we're going to be talking a little bit about our book, but also a little bit about some other items too. But the first thing we want to talk about is a theme that's come up a ton, which is the concept of value add. Okay. So value add has been hijacked to a one-trick pony, it seems. And I can understand why. And a lot of times you think a value add, just, because so many people in this business go from, let's say, flipping a townhome, flipping a single family home in some random part in the country. And then they maybe read a book, they go to a boot camp, they go to a seminar, they go to a cool conference. And then someone gets on stage and says, oh, well, if you're doing a single family home, then, why don't you do 20 units? And if you're doing 20 units, do 200 units, right? We've all heard that spiel, and there's nothing wrong with that. I hope that's not like a patronizing thing, my tonality here. But the point is that value add has been hijacked to just change the color, change the kitchen out. And all of a sudden, that's the only way to do a value add deal. But that's not how we view the world. And we kind of want to educate people as to the more holistic way to value add and also the more cost-effective way to add revenue to a property, because value add is ultimately a proxy for adding revenue and increasing the value of a property. So that said, Sam and Rob, can you kind of break down the things you've been hearing and kind of the misconceptions and maybe some of the, I'm not going to say frustrations, but the conversations we've been having to have of late in reference to this subject?
Yeah,
Sure.
I'll jump in a little bit here. I mean, because I actually do get to talk to a lot of passives and groups and that do single family and multifamily. And, one of the big deciphering differences between those two, right, is because when you go do a value add, say for a single family, you have to understand that you're only going to be able to sell that home for what the sales comps in that area sell for. So you can go put a whole bunch of money into it, make it the very nicest thing that's there, but it's still only going to sell for what the values are in that particular area. With multifamily, it's slightly different because you're able to do what we call force appreciation. So we get so much of our value from what Craig alluded to is that NOI number that you hear us talk about, which is that net operating income. And the more you can increase your net operating income, it's tied to a trailing exit cap rate or, whatever that terminal cap rate is. And that's actually how we get the value for these larger multifamily properties because they're looked at and valued on a commercial basis. And so, that first distinguishing factor of understanding like, hey, when we're going in and doing a value add to what we do, it's based upon a value that is somewhat market driven and can actually be higher than the person next door because we're looking at it from the income, the net operating income that it's produced from that value add.
So what I'll add as well is when you get familiarized in the multifamily business, particularly kind of on the syndication level of things, there's a couple terms that, to use one of my favorite words, become hackneyed. And hackneyed, as the word of the day, is, I've got the definition here, of a phrase or idea lacking significance through having been overused, unoriginal, and trite. Basically, you use something so many times that it loses its meaning. And this is exactly what value add and its very good cousin off market are. They're hackneyed terms. So when you get into the business, all of a sudden you hear the three words or phrases over and over again: off market, value add, multifamily. And those things just go hand in hand in hand. And the reason why value add becomes hackneyed is because basically, in order to make an investment opportunity look more attractive, every opportunity is touted as a value add, right? Basically, no matter what the deal is, look at how much meat is on this bone. There's so much opportunity. We can add so much value to the property. Like Sam was talking about, forcing appreciation. This becomes really the shining, the guiding light that people are looking for. They want to figure out, okay, I don't want to just invest into a stabilized deal or a cash flowing deal. I want to invest into a value add where value can be increased rapidly as well as in a controlled fashion, not just leaving it up to chance and up to appreciation. So that's why it's been hackneyed, is because everyone's using that same pitch to attract investors into deals. And the way that goes wrong is two ways. One is people start pitching deals that aren't really value adds as value adds, right? They're buying a 2024 new construction property, but it's a value add, right? Because for whatever reason, right? Because the developer left the finishes not to a premium, or because the developer didn't build out private yards and they left that meat on the bone for the next guy. But bottom line is, it's very difficult for a 2024 vintage asset to truly be value add. And then the other thing that's fraught about painting everything with the value add brush is what really Craig was getting at the very beginning, which is investors start getting stuck into this one trick pony mindset that a value add always has to be a certain way and it always has to look a certain way, which in its most classical form would be by way of interior renovations, which we can all picture the before and after of the kitchen, right? With the old countertops, with the old cabinet fronts and the old appliances. And then magically, we've got stainless steel appliances, we have a backsplash, we've got hard surface counters, and then voila, you've got $200 higher rents. And just to finish off, because I could go all day on this, obviously, just because you renovate the kitchen doesn't mean you can get higher rents, right? There are market forces at play here.
Exactly. So I actually had a couple of notes to go through that. I want to do my preamble and then let you gentlemen cook. So thank you for the beautiful feast you just made here to set me up for the next part of this, which is when the market is shifting like it had, and when the market was super hot, when so many people just got into the business, right? When, let's just say the market was frothiest and kind of the ZERP environment and zero interest rate period, call it really between 2016 to 2022, when every conference was stuffed, when, rates were nothing, where evaluations were at all-time highs artificially, and there wasn't that much supply coming online, and you could actually, really, it made a lot of sense to put dollars into deals, and then you would get, a lot better of a evaluation of your property if you did improve it a bit and you had a new rent roll in there, and then you could sell it to the next person, right? Well, when the market does shift, your strategy needs to shift as well. And the issue with the value add world, right, the traditional value add world where you're spending $10,000 to $15,000 a unit, is when there's historic levels of supply coming online, like we've seen the last couple of years. 2025 has been a lot better, right? When you've got historic levels of supply coming online, and then you're spending $15,000 a unit and you're close to replacement cost, your math doesn't work anymore. Okay. So you're not going to be able to get, these massive rent bumps when there's all sorts of pressure on your property, because tenants are able to go actually up a grade almost in value of a property, right? If you are an 80s kind of tenant typically, and, there's a discount down the road for 90s and 2000, before you live in the nicest 80s unit with low ceilings, you're going to go to the place with higher ceilings with better amenities because it's a better property. So the value add world, it struggles to work when you're only doing the value add from a cosmetic perspective, where you're spending, 15 grand a unit to get a $200 turnout. Doesn't really necessarily work when the market is shifting and changing. And that's something that you have to think about, is as dynamics change, your business plan and strategy needs to shift as well. So you want to make sure that you're pivoting accordingly, and kind of what we've done at Lone Star, to talk our own book, because we will, and I will, is we've been doing a lot of the tax exemption routes where we're creating value by not having to increase rents, or we are not necessarily raising rents, but adding on an amenity fee, or kind of finding out what's going on in the area and what is this property lacking, and increasing that, and being wise about where we spend our dollars to achieve a better NOI and a better lift on that property. But it doesn't have to go with paint all the time and, changing our kitchens. I think that's kind of, those deals do work, and we will do those deals for sure when the market makes sense to do it. But for the foreseeable future, we do not really think that's the best way to go about creating dollars and value in the marketplace, because think about everyone who did all those deals in 21 and 22. Okay. Think about everyone who, bought it for X price and then wanted to put X dollars into the deal. Your basis now doesn't make sense, but also you just burnt all those dollars on turning in units instead of just keeping reserves on hand. So those people are really going to struggle. Any value add deal that was acquired in 21 and 22 basically burnt all the dollars that they actually probably invested dollars in CapEx there.
Yeah, there's a lot to unpack right there, Craig. What I would tell you this, and kind of getting back to some of the basics of it, is a value add really is anything that's going to increase the NOI, right? Increase that net operating income, and we're talking a lot about the physical value add, right? Which you're alluding to other things. Really, there is a couple different ways to do value add, right? There's operational value add, right? Which we pride ourselves in at Lone Star being able to do, right? Because there's things that we can do operationally that can enhance the value of the property. There's financial value add, right? You can change the structure of debt or add software to help with collections and things like that. There's all kinds of things that you can do that would be under the guise of value add, right? And the physical value add that you're talking about, Craig, is something that it's fairly easy to measure too, because if market rate is here and we go and do certain things to whatever those things are in the interiors, like what you're saying, 10, 15,000, but the trade outs aren't hitting the number that we're trying to hit, we're losing that value. So, and in some cases too, I mean, I'm involved in deals as an LP where we've spent a ton of money doing this type of strategy and the trade outs became negative, meaning everything that we spent was gone because the new leases that are coming in are paying less than the old leases. And
So think about that.
Because of that supply issue.
Yeah, think about that. If you are a owner and you spent $15,000 x 200 or 100 units there and you're getting a negative trade out, the math on that is so poor. You will probably in that 10-year span, maybe 5-year span of owning, unless rents really ramp up and go crazy, you will never get that money back, unfortunately.
Yeah, it's gone, unfortunately. But there's from a value add and a physical perspective, there's a lot of people, they look at it different ways. Even investors look at it different ways. And from an asset management perspective, true ownership of what we're trying to create from it, there are a lot of examples out there that make a lot of sense, right? We're looking at a deal right now where we're talking about adding washer and dryers to the units, right? There's connections already there, right? But it's something that would be an amenity that we're adding to the unit. So let's just say that spends $1,200 for that unit to add in that washer and dryer. We will be able to really dictate a premium associated with that because, one, we're giving a resident something and we're showing a fee associated with it. Now, our hope is that we can charge, say, $50 a month in addition for that $1,200. And so a lot of people would look at that and sit there and go, all right, well, at $50 a month, you're spending $1,200. It's going to take you 2 years to earn your money back. That's how a lot of investors look at it. And that's not really the case of how we look at it a lot of times. It's good because it gives us that additional cash flow. It gives us that stability. It provides amenities for what, those investors are looking for. But, if you were to say, all right, well, hold on, if this $1,200 investment is getting me an extra $50 a month and I'm able to equate that way, right? This is kind of the simple math of doing it. If I put it on a 6 cap, that $1,200 improved the value of the property by $10,000. That's the forced appreciation that we're talking about when we're doing value adds. And there's certain things that you can do, right, that are very easy to calculate like that. Then there's other things that we do that are really kind of hard to calculate, right? And I'm talking about more that operational side of things, right? So that same property, we may be going in and going, hey, we need to replace some of the air conditioners, right? And you would sit there and you go, is that truly a value add, right? Well, in some cases, I would say, yeah, it is, because if we know that we have an immense amount of work orders each and every year on these ACs, or we know that a lot of these ACs are going out, it's fairly simple to look at this and go, hey, we're in Houston, Texas. It's still September right now. We're in the 90s today, right? Your AC goes out and it's 85 in your unit. it is highly unlikely that that resident is going to have a good experience with that and that they're going to sit there and go, man, I can't wait to renew to live here. It's unlikely, right? But there's value in the perspective of going, you know what, when we take this property over, we're going to go ahead and change that out. We're going to spend X amount of dollars to do it, but I'm going to know that I'm going to be able to give consistency of cool air when somebody wants it in their unit, in their resident. That resident's going to be happy because they have the ability to go, I'm not going to have to worry about this, right? And you're taking away their excuses to leave, which can be actually fairly dramatic. Remember, it's about increasing the NOI. If that resident leaves, it costs us a lot of money to turn that unit, to release that unit, right? To sit there when it's not making income. There's a lot of money associated with that, right? And so if we take care of the things from an operational value add perspective, it's hard to calculate that up front, but it absolutely can increase the value down the line.
Got it.
So I'll add another element, which is my own personal perspective, which is frankly, I'm pretty negative on value add in the traditional sense of spending money on a property to improve it. And the reason for that is because it's very difficult. And I think that the market generally underprices the risk and difficulty of doing it. And so obviously as investors, we want to be wading into risk that we think is mispriced in our favor, not against us. And so when everyone's saying value add and when everyone is understanding or under-respecting the risk and difficulty of value add, that's where you don't get really paid for your work. And so that's one of the reasons why I'm so negative on value add. And to put that into a real world perspective, if you want to buy a property that has a value add opportunity, unless nobody else knows about the value add opportunity but you, unless that is true, then the price is actually going to reflect the embedded value add opportunity. Meaning, if it is clear as day that you can buy the property and renovate the units and increase the rents by $100 or $200, then the cap rate that property is going to trade at is going to reflect that. So it will trade at a below market cap rate for what would be a stabilized comparable property. And so that's one point that makes me kind of conscious and a little bit risk averse to value add.
When you say below market cap rate, you mean that the cost per unit will be more expensive. Is that correct? I just want to clarify that.
Well, the cost per unit could be lower than perhaps a stabilized equivalent, but that's because the income of the property is lower, right? So that could mean that the units are original and the rents are $1,200. And if you renovate them, you can get them to $1,400. But it's almost as if you are paying the seller the price for the asset as if the rents were already $1,400, because it's so baked in and it's a foregone conclusion that you're going to be able to do that. And that's something that I'm not terribly interested in. And so other groups are more interested in that because they may have a better construction process than us. And maybe they have a construction company that they use and it's a profit center for them. And so they actually deliberately seek out projects that are more of a construction project than really in a real estate investment. And so we do construction in-house because we have to, not because we want to, right? We don't want to make money from construction. We want to make money from investing in real estate. So doing in-house construction, in my opinion, is a necessary evil, but I don't want to be a construction guy. And then finally, my other big point, which is kind of like it's like a conspiracy theory or just to burst people's bubble, is there's causation and there's correlation. And don't confuse brains with a bull market. So back in 2015, 2016, 2017, 2018, I mean, these were remarkable years to invest in multifamily real estate. And it almost didn't matter what you bought, whether you bought in a good location or in a bad location, whether you bought a newer property or an older property, whether you bought a stabilized asset or a value add asset. It didn't really matter. Whatever you bought was going to go up in value because rents were going up and cap rates were going down. So a lot of people just so happened to make remarkable returns on value add deals because they bought value add deals during that time. So it wasn't that they had great returns because they bought a value add. It's they got great returns because they bought something and it just so happened to be a value add. So in my opinion, a lot of these amazing results from value add deals are conflated by just really the time period at which those value add deals were done. And if you were to just have bought the same property and didn't value add it, and you just kind of held it for a couple of years, and then you sold it to the next guy and they were going to value add it, you would have probably gotten a fairly similar return. So that's my conspiracy theory. I don't know if exactly that's 100% true, but that's how I feel.
Well, you can also add in one other big thing there too, because we talk about rents, right? When we're doing this, right? And if let's say you go by, and we specialize in workforce housing. That's what we specialize in. There's going to be a ceiling to the rent in any location you buy, right? And what we're trying to do is trying to constantly figure out what that ceiling is. And there's different ways to do that and nuances to do that. But if you go in and you say, all right, hey, we have rents here, they're $1,200. We think that ceiling is $1,400. We're going to start doing some of these things to see what we can do to get there. You have to be very judicious in what that value add looks like to get to that 1,400, where that value truly is, because the resident's going to tell you what they value, right? And they're going to tell you by leasing the unit, right? And you could sit there and go, all right, well, hey, I'm going to add in all these other things, and I think I can get it to $2,000 a month in rent. Well, you're not going to be able to lease that if the ceiling is $1,400. And so it can be cannibalistic, right? You start going in there, I want to do all these things, right? I'm going to put in new countertops and do new cabinets and do all this other stuff. But the resident may sit there and go, look, the most I'm going to be able to pay for this type of unit is going to be this number. And so you can go in there and over renovate, like what Craig was talking about earlier, and you're not going to get the value associated with what you're doing. And so you have to be somewhat specific on what you're wanting to do to get the value for it that the resident's willing to pay.
I have a couple more points here. So number one, so many properties that were value added in the cycle beforehand, call it from really, I guess, probably post GFC. So let's just be more conservative here from 2014 to 2021. Okay, how many more properties are truly left that are so much low-hanging fruit where it makes all the sense in the world? I mean, you see so many of these properties. James Zhang, I think, really points this out where he sees like the loan mounts and how like recently the new deals that have been trading, the loan mounts are going down, which means valuations are going down because leverage can't be as good. But how many properties are truly left to be value added where you've got truly original units for 90s, 80s product where the value add turnout actually makes sense? The answer is very few, because what wasn't trading the last couple of years, unless you're really a legit, the Hakeem Olajuwons of the world who, buys properties and then never sells them and then holds them indefinitely. That's such a niche and small amount of kind of owners, if you will, and properties in the marketplace. That just doesn't really often happen. So that's point number one, that so many deals were really value add. They were hot potatoed. So is there that much margin room here? I don't know. And then are you going to junkier neighborhoods to basically put a square peg in the round hole to make that kind of business plan work? That's a point to think about. The other thing that you really need to think about is when you do these value adds, you're paying, as Rob mentioned, a really compressed cap rate because the revenue's down, but a compressed cap rate, so probably too high for door. You basically need to spend that $10,000 to $15,000 a unit, because it's not 6 to 8 anymore. It's 10 to 15K. And you basically need to reset the market for those comps in the area. And now you're really competing in most instances with what? You're competing with 2000s, 2010s to current new construction product. That's just in our opinion, a losing strategy, because you really need everything to go right for that value add to go well. Who is making money? The company that bought it, the company that's doing construction management on it, and then is, doing asset management fees. So really, in a lot of these instances, a lot of these people those are the ones who are the real winners, is the operator, not necessarily the investor. So that's not to say that they're not, niche opportunities where it does make sense. But for the boilerplate, every single deal being a value add where it makes sense is just a thing I struggle to learn. And, as Rob mentioned, the sugar high of the past marketplace, everyone kind of wanted to do value add because it worked at that point. Well, anything would have worked at that point. So you got to look at these conversations more holistically as to where you can create dollars. And the other thing that I have on the final point of this is what we've been doing recently and yes, I am talking our own book, is we want to buy stuff where maybe there is some value add today on the units. Yes, there's some original units or whatever it may be. We need to figure out, well, on the back end, who's the next buyer of this property. And we know, like a moth to the flame, so many buyers are going to be attracted to our properties because there's interior value adds to being done. So I hope they're not listening to this episode. But that said, there's going to be a lot of meat on the bone for the 2 acquisitions we've done at this point. Discovery at West Road, I don't know if I'm allowed to say that or not, but that property, there's a lot of more original units that someone will be able to, enhance those units on. And then our next property, which I probably shouldn't say, will similarly have that opportunity to have that increasing of value via the interior units there. So when I think about those things, I just want to be in the business of buying the property at the best basis. And maybe if I hold this property for long term, then maybe we will do some of these units. Maybe we'll replace a segment of them, like 20 of them, to a premium finish and prove a concept there that, hey, for the next buyer, here's the meat on the bone. Here's your value add. But solving for what we're going to do for our enhancement plan and what the next person's going to do is something you have to think about for any deal. And that's really what the most sophisticated investors are thinking is, okay, what are we doing and what are they going to do, right? Where is the market on the back end for this particular property?
So, Craig, you mentioned long-term holds as an example of what could create a value add, where somebody bought a property, let's say in 1990, and it was maybe a 1990 vintage asset. And at the time, it was a brand new property. So it was at the top of the market. But then if that person held for 20, 30 years and didn't do anything to the property, well, that property will certainly have gone down in value or in condition and actually be a value add opportunity, right? So you used an example of a long-term hold, but also made the assumption that it would have to be a long-term hold where the owner was to some extent negligent and didn't actually upkeep the property. Or maybe they upkept it to the very bare minimum, but they allowed the property's position. They allowed the property's position to slide relative to its competitors, right? And therefore, it creates a gap between the property's rents versus market rents in the area, right? However, there's nothing stopping a long-term holder, kind of what you also said at the very end, which could be a situation that we might find ourselves in. There's nothing stopping a long-term holder from actually doing a value add slowly over time on their own property as they're responding to market forces. If there is demand, and you see this every day, right? People walk into your leasing office and they say, I like this place, but I'd love if you guys if there were upgraded counters. All I want is really upgraded counters. And then the owner might say, okay, fine, I'll upgrade the counters. And then, for a couple $1,000, I get a couple $100 higher rent. I mean, Sam just proved out how lucrative of a value proposition that is. So in reality, the distinction between what makes an environment great for value add is actually a lack of capital. And that's exactly what we didn't have in that period that you're talking about, the recovery period from 2014, 2015 to 2022. There was an abundance of capital. So there was just a wave of capital that found itself into every nook and cranny of every deal. If there was something to do, the money was spent, right? If there was a renovation to do, if there was a property to buy, there was just an abundance of capital. So of course, that really didn't leave much room for true value add, because you actually have to have some sort of destruction of value in order for the value add to occur. So funny enough, everything's a cycle. And so while we've been poo-pooing value add on this podcast, that's because it was kind of popular, and then it's not so much, and then it will become popular once again. And so what we've had over the last 3+ years now is an environment categorized by somewhat of a lack of capital. There's been less transaction volume. Owners themselves are constrained because they're financially at risk, because they might have a loan maturity, they might be debt service constrained, and they're struggling from a financial perspective. And of course, what happens when you're having difficulty making your loan payments? You're going to skimp out on CapEx and deferred maintenance repairs and things like that. And before you know it,
you're just trying to pay the loan.
Right. And before you know it, that property is going to fall behind. And that owner's at some point potentially going to throw up their hands and say, you know what, I've had enough. I'm going to sell this property. I'm going to recoup what I can. And a new buyer who's going to be bold enough to invest in an environment where no one else is investing. And they're going to say, you know what, I see the potential that nobody else sees. And when you have that scenario, that's where value add really allows you to make a killing. And you have to kind of really, as an investor, look around and say, is there a lack of capital? Is there fear? Is nobody else doing what I'm doing? And if so, your value add opportunity has a chance at being great.
So another thing on this subject here is Sam and I were presenting a deal not too long ago to someone, and we were kind of breaking it out. And I guess shame on Sam and I for not posturing it better. But we were saying, hey, all right, we're going to do this, partial tax exemption on something, and then we're going to do this ancillary income item. We're not going to improve rents. We're not going to increase rents, but we're going to add an income item that's not here. And the person goes, okay, great. Well, what's the value add? And it's like, wait, what do you mean what's the value? We just told you what the value add is, but that individual, and that's fine. We need to be out here to explain to people how that is the more appropriate and more mature value add in today's marketplace. So the cycle will reset itself, where probably there will be some more hot potatoing, and call it 4 to 5 years when multifamily is back to the greatest thing since sliced bread. But the funny thing as well on that topic is the best deal in our portfolio, arguably in the history of Lone Star, was none other than Preserve at Copperleaf, formerly known as Cortland Copperleaf. Okay, well, that deal had no value add technically from a interior renovation perspective, but yeah, we were able to, after 13 months, do a 45% cash out refinance. And that deal is currently cash flowing at 8%, trending to get to 10% shortly here. And what happened with that deal? We put a tax exemption on it, and we also managing it very well. We have our income items on it, and that's how we're able to achieve that. So I'm not saying that every single deal that we're going to do is going to have that outsized result, but that deal was getting scrutinized, I recall vividly, not to Sam, of course, who wasn't with us at that point, but he saw the basis there as a Houstonian was too ripe, and he also lived not too far away from it. But with that said, he saw that, and that was the exact property he wanted to jump on. And we acquired that deal when the liquidity is at its worst, and when there's the fewest buyers in the marketplace. That deal was locked up, I believe, in November or December of 2023, when things were pretty darn slow. We were able to put a tax exemption on it, our extra income items on it, and now it's occupied at 97%. And we had once more had a 45% cash out refinance. And we had people screaming, hey, I just don't understand. How are we going to improve and increase the value of this property? What are we going to do? And lo and behold, I think we did that in spades. And there could be some upside for the next buyer in 3 or 4 years when we sell it to increase some interiors.
Well, it's so funny you say that, because I'm actually talking tonight to a large group of passive investors about Preserve. We're doing the case study, and part of the hook, if you will, or at least the understanding of it is, hey, not all value adds are physical. Kind of like what we were talking about, right? Not all value adds are physical. When we were able to put this into an affordable strategy, right, and now offer a certain amount of units to, what we call that little A, not the big A, affordable, to the residents who live, work, and play in this particular area where there was definitely a need for it. We took over a property, and if you look at the pictures of it, it's immaculate. Like the interiors are beautiful. The amenities are resort style, amazing, right? Anybody would want to live there. Like, it's one of those things where it is not a hard place to live at all. It's an ideal place to live if you live, work, and play in that area, right? And what that did, and what I'm going to show them is, hey, here's the exemption. So here's how much our expenses dropped from a tax perspective of what we had to pay each and every year, right? Here are the expenses we have associated with the strategy, what we're going to have to do to pay back associated with that strategy. And here are the decreased in rents that we're going to have to do. And I said decreased rents too for this strategy. But the net of it is a positive. And it was a fairly significant positive where it added millions in dollars of value to the property. And because we were able to do that, and because of the value out of how we structured it, if you remember, the way we structured that deal from the beginning was we didn't go out and do what we typically like to do, which is take long-term fixed rate debt, because we needed the ability to get that strategy in place and then go and refinance the deal. So there were all kinds of value adds that were happening that had nothing to do with the physical aspect of the property. And because we did it the way we did it, right, 13 months later, we were able to take about 45% of the investor dollars that had already been invested. And that's not what we've been paying them along the way, too. That's just what we were able to pay them in one chunk back of a return of capital back to those investors in 13 months. And it was because of that single value add strategy. It was such a large value add strategy that we did. It wasn't physical. It was more operational and financial of all the things that were happening there. And it amounted to a huge return to those investors in a short period of time.
Yeah. So in summation here, to put a bow on this subject, and we'll get to the next one, is we want to find deals that are not the highest in the rents in the area, not the lowest, probably somewhere between lower middle tier in rents in the vicinity, where there are some units and some, enhancements that could be done, but really where there's not a lot of extra income added and there's some sort of deficiency on or lack thereof efficiency and some extra income items that are not done. We want to do that coupled with some more original units, because then we can add our business plan and then sell you the value add to do because of this conversation. So that said, I think that thoroughly covers how we see the world of due diligence. And if you want to reach out to myself or Sam in reference to how we are viewing the world and have a more intimate conversation on this one-on-one, Sam and I are happy to talk to you. My email is craig@lscre.com and Sam's is sam@lscre.com if you want to reach out to us, learn more about our process, what we seek, what we're looking for, help you, help me. That said, let's get into our DD process. DD is obviously due diligence. And when you're acquiring any sort of real estate, doesn't matter if it's a home, doesn't matter if it's industrial, self-storage, office, there's going to be a due diligence process, right? So we are going that on a secret acquisition right now that'll be released to you maybe in a couple of weeks here. But we're going through that right now, and we're actually getting better and better and better in reference to our processes from every single perspective, from operational, from our marketing perspectives, you name it. We're trying to optimize as we speak in real time right now. And we've been able to do that really over the last kind of 6-8 months because we weren't really acquiring any deal until recently because nothing really made sense. But now deals are starting to get a little more ripe. But Sam and Rob, can you guys go into our due diligence process, the evolutions of it, what's changed and kind of what we're looking for and how we're kind of ultimately improving our processes to streamline the underwriting and to better help benchmark ourselves? Because we as operators, we do monthly reporting and monthly distributions, but on our monthly reporting and our quarterly reports, we benchmark ourselves versus projections and actuals. So we hold ourselves accountable on a monthly basis. So with that said, our due diligence process needs to be thorough. So once more, what are we doing to optimize that process to increase confidence and build trust with our investors?
Yeah, so I think Sam was just on site at a due diligence that we conducted, so he can speak to that. But from my perspective, I think that we have done we've done many due diligences at this point, and we've done third party, we've done in-house, and so we've had different experiences. But now we're really starting to refine our in-house due diligence process and have upgraded software, streamlined process to be able to more quickly and more efficiently walk every single unit, which is a necessary thing to do during due diligence. Even when you're buying 200, 300, 400 unit properties, you still need to walk every single unit. And with the use of software and a lot of hard work, we need to keep track of the condition of the major elements of every interior. So you're talking flooring, paint, countertops, HVAC systems, and that way we can get the most precise CapEx budget possible. And not just CapEx budget, because the work is never a one and done. With a property is a business, it's a living, breathing organism. So you can't just spend money once on the property and say, okay, now it's fixed and now it's good, because everything's going to just break at some point or another, right? We talked about on the podcast, I think last episode or so, on a long enough timeline, everything becomes recurring CapEx, right? Even roof replacements are a recurring expense on a long enough time frame. So with that being said, Sam really says this best, that when you are taking over a property, that is your one shot to make a first impression and to really start the deal off on the right foot. And I think that's where we are really making strides to improve. And because in the past, we've done the due diligence, we've done the thorough walk and audit and inspections, but that kind of stayed siloed. It's like we did this great due diligence, and then we got this pretty package, and then that was it. It didn't actually connect to our business plan so directly. But yesterday we had a meeting here in the conference room with everybody. Brad, our director of acquisitions, myself, the asset manager for the deal, and more. And we were just specifically looking at the due diligence results. So what are the cost estimates for the projects that we want to do, and what are the projects that we want to knock out right away? Because just because you need to do something doesn't mean you need to do it the day you take over, right? You don't have to replace all the HVACs, for example, the day you take over. You just need to be budgeted to do them at some point to the extent that they need replacement. So it's really getting refined on what is the plan of action, and then having a budget behind that plan of action, as well as the feasibility to execute, because we're not just throwing numbers on a spreadsheet. This is actually requiring real people and oversight to actually, swing hammers and make things happen on site. And so we have to be cognizant of, where is our talent? What projects are they working on? When we'll be able to pull them from one project and move them to another. And so it's really, I think from an operational perspective, we're getting much savvier that a takeover, we can hit the ground running.
Yeah, and it's and like you said, it's becoming more specific, right? And that's one of the things that I love about DDs when we're going on site, in particular when you get to walk units too. And that's what a lot of people don't realize. I mean, these are people's homes, and so we're very conscious of that when we walk in. These are people's homes. We're going into their homes, and it's under the guise of, yes, we're trying to be the new owners of this deal, but we want to make sure that we're providing you the best possible home. And so it's as specific as when you go into a walk. I mean, we're not just looking at all these things, we're checking it all. So, the air handlers, the AC inside, we're taking off the cabinet. We're looking at it. Is it clean and cleared out? Is everything running well? There's no leaks with anything. We're turning on every faucet. We're turning on every appliance. We're making sure everything works, right? So that resident is going to be happy, right? And when we do inevitably find things, because there are things that we'll find through the walkthrough that have not been requested as work orders, what Rob is talking about is, we can put together that team in the first few weeks of ownership to go, all right, hey, we're going to go take care of all these, for the most part, minor work orders. It's deferred maintenance, whatever it may be, so that they don't, become major work orders later, right? And really so they don't become work orders later, right? And so the on-site team that's there, they start fresh and new. The maintenance team that's there, they're able to handle all the things in a more expedient fashion. And if you're doing these things with, like what I told you, the renewal in mind, because that's where we make a lot of our money when that resident stays. It's not when the resident moves out and we can charge more money or whatever for a new resident come in, but when the resident stays, because we've taken care of their home and provided them safe, comfortable place to live, that they want to be there, they want to stay. And this community is a great community that we're looking to acquire right now. But it shows that we care too as owners. We're showing up, we're doing it in an expedient fashion because we want to be as little disruptive to their life and their way of life as we can. But we're taking care of the property. We're showing them that we're having pride of ownership, and they should have pride to live there. And so the DD is really our opportunity to be able to do that. In addition to that, one of the things that Rob had said is that it helps us create that initial CapEx, right? I think our CapEx in the past, we would really highlight the big chunk items, right? All right, well, hey, we're going to handle, roofing repairs. It's going to be X amount of dollars. We're going to handle ACs. It's going to be X amount of dollars. And we keep really that 4 or 5 items that we really are focusing on, because that's really where the chunk of the CapEx is. We now have a list that's probably 50 items with this DD. Now, some of them are really small, and some of them we don't have to do day one and things like that. But when an investor comes in and says, oh, hey, so what all are you doing? And we have the ability to go, well, CapEx is actually $864,312.18. Like, we know it really specifically what we're going to spend and how we're going to spend it. And we can actually show you all 50 items that we're going to end up doing. It shows that we've really looked at the deal. We've actually gone through and we've we've adequately been able to pick out all the things that we want to be able to do to get to this business plan that we're presenting.
So when you look at our deals, if you were an individual owner, right? Like let's say you're mega rich, you're a centimillionaire, and you want to buy some multifamily real estate, you would probably not front end raise dollars for a capex budget, right? You would likely probably just buy the deal, maybe have a little bit reserves in the bank there, but you're not probably estimating dollars on an ongoing basis. But when you do our investments, you have to acquire the property at a great basis. You've got to pre-raise the reserves for the deal from investors, and then also the improvements, the capex dollars for the deal. So you have to be very precise. And the last thing that we want to do is walk into an acquisition and be underfunded on important items where, by the process, either cash flow is going to get hit or the deal is underfunded and, it could go under, or we have to make, God forbid, a capital call into one of our deals, basically asking for investors for more dollars to fund said projects. So the more thorough and precise we can be on the front end, the better we can project and estimate how this property will go. And we'd rather be a couple dollars overfunded and do a special distribution once, call it we are, in a couple of years into a deal and we've got proof of concept with cash flows from a historical database, because ultimately, one thing that Rob and I have really harped on before is one of the riskiest parts of the business and any sort of investment is the takeover process. And when you acquire a deal, what do you actually have once it's yours? What's under that hood? You don't want to buy a lemon. You don't want to buy a property where all of a sudden, oh, shoot, everything's broken. I don't know how this person did this, or there's mold, or there's some sort of unforeseen, expense there. That can easily happen if you're not thorough on the front end. So the more thorough we are, the better we can kind of benchmark our opportunity, the more we can accurately predict what we need to be done. And we'd rather have a couple extra bucks than a couple dollars too few, for obvious reasons.
Yeah, and it goes beyond that too, because if people understood, like we have experts in the industry that are walking these units, that are looking at the lease files. We have experts in this stuff that are doing this. So it's not to say that an investor can't get to that level. It's just when you're going into a unit, do you have somebody who's HVAC certified, who absolutely knows what they're looking at and can tell you, yes, this is in good shape, or no, we need to do a repair here, or even worse, hey, this needs to be changed out. I'm sorry, this is going to fail in a short order, right? And having those abilities for all, to be able to do that in-house is a big dramatic thing. And like you said, having those funds up front, it changes the game for us too, because like you said, you don't lose in this game unless you run out of time or money. Because if you run out of money, right, it's going to force you to do certain things with your investors that they're not going to be happy about, right? If you have to go back to them and say, hey guys, we really miscalculated it. We need another $1 million. And oh, by the way, we need it soon because we got a roof that's failing or something like that. And we're going to continue to lose occupancy, and it's going to compound itself and be worse. If you have the ability to look at all these things ahead of time and say, like, hey guys, this is an issue. We have to take care of this now. And it's going to enable us to adhere to this business plan. You do that all up front because it allows for that consistency in the ownership. It allows for that consistency in our monthly payments that we provide to our investors. It allows us to have better employees, believe it or not. It's an easier property to manage and operate. So there's so many operational things that occur with that. So if I had $100 million and I just wanted to buy some but I have to recognize I might have to feed it later, right? We take care of it right now, all up front, and make it to where we're not going to have to feed it later, or that the property itself can feed itself later because we took care of all the things that needed to be taken care of up front.
Yeah, it's kind of like this, if you're a football player, right? Would you rather be playing on your heels or on your toes? Well, it's obvious. You want to be playing on your toes. You want to be attacking. You want to be on offense. You don't want to be a year or two into this property down 14 points and the other team's just running the ball down your throat. They're throwing it over you. You want to be on your toes, being smart here and, attacking these items that could be, cash flow drags to the future and could, really ultimately crumble your reserve bucket. I mean, as Joe Fairless, best ever real estate syndication book said, sufficient reserves is the key to any deal. So with that said, we really appreciate listening to the LSCRE podcast today. Thank you so much for being here. If you want to learn a little bit more behind the curtain as to how we work at LSCRE, let us know. Let me know. Email me at craig@lscre.com, sam@lscre.com. We look forward to talking with you soon. Take care, everyone.